Hi there. In this video, we explain when inheritance tax can be paid in installments and how this can help manage large tax liabilities effectively.
For decades, the United Kingdom's inheritance tax system allowed for the intergenerational transfer of productive wealth without triggering an immediate liquidation event. Under this regime, the founder of a highly successful tech startup or a robust manufacturing SME valued at £10 million could pass that entire equity to their successors with a tax liability of exactly zero. That baseline reality shifts entirely in April 2026. Through specific legislative reforms, that exact same £10 million estate instantly incurs an overnight tax liability of £1.5 million. This creates an immediate operational crisis. Most thriving £10 million enterprises do not hold £1.5 million in idle cash. To satisfy His Majesty's Revenue and Customs, executors face the very real threat of a distressed corporate sale or the forced liquidation of core assets. ProTax Accountant is a specialized UK accounting firm navigating businesses through complex HMRC compliance requirements, constructing strategic tax frameworks that protect operating capital. The 2026 Inheritance Tax Framework makes succession planning a prerequisite for maintaining corporate solvency. To solve this liquidity crisis, we will first deconstruct the precise mechanics of the new £2.5 million relief caps. Second, we will identify the specific asset classes that legally qualify for the 10-year statutory installment payment framework. Third, we will calculate the severe financial divide between interest-free tax deferrals and interest-bearing liabilities. Finally, we will detail how to navigate the procedural grant-on-credit tool, a mechanism required to access corporate bank accounts while tax liabilities are being settled. Mastering these four structural elements provides the only viable defense against the total depletion of a company's treasury reserves. The crisis originates from a single foundational legislative change. Business property relief and agricultural property relief will lose their unlimited exemption status. HMRC is implementing a strict new threshold, 100. The chart drops by the new £2.5 million allowance, removing that value from the taxable equation. Because the standard inheritance tax rate is 40%, applying a 50% relief to the excess generates an effective tax rate of exactly 20%. Applying that 20% effective rate to the remaining £7.5 million of our example SME illustrates the math perfectly. This is the exact mechanism that generates the £1.5 million liability. Under strict statutory rules, this liability is payable exactly 6 months after the end of the month in which the death occurred. This unavoidable mathematical reality means directors must adopt alternative HMRC payment structures immediately to avoid gutting their operational capital. The primary statutory lifeline for this liquidity trap is found in Section 227 of the Inheritance Tax Act 1984. This provision permits the payment of inheritance tax in 10 equal annual installments. HMRC targets specific illiquid assets for this relief. To qualify, the estate must contain unlisted trading shares, agricultural land, or controlling corporate shareholdings. This sorting diagram clarifies the boundary. While operating assets move safely into the installment column, highly liquid holdings like cash reserves and standard listed market shares do not qualify. They require immediate settlement. This specific eligibility profile offers a layer of protection for contractors operating through limited companies and founders holding significant unlisted startup equity. There is a unique anomaly in the 2026 rules regarding shares on the alternative investment market, or AIM. While AIM shares completely lose their 100% relief status, they retain their legal eligibility for the installment option. Securing eligibility for this framework is critical. It converts a fatal, immediate lump sum tax bill into a predictable, long-term operational expense. Securing an installment plan is only the first step. Not all HMRC tax deferrals carry the same cost of capital, and this creates a severe bifurcation in long-term financial modeling. The primary operational advantage for assets qualifying for business and agricultural property relief is that their 10-year installments are entirely interest-free. Looking at the left side of this split-screen graph, we see the projection over a 120-month timeline. For our £10 million SME, this translates to a flat repayment of £150,000 annually for a decade, with zero financial penalty. Contrast this against non-qualifying illiquid assets, such as residential investment properties. As shown on the right, utilizing the installment framework for these assets attracts a punitive late payment interest rate. The debt exponentially accelerates as compounding interest is applied to the outstanding balance. This punitive rate is anchored directly to the Bank of England base rate plus 4%, resulting in a current yield of roughly 7.75 to 8.5%. Furthermore, the framework carries a strict compliance trigger. If the business or the qualifying asset is sold at any point during the 10-year period, the entire outstanding inheritance tax balance becomes payable immediately. Failing to separate interest-free liabilities from interest-bearing ones results in compounding debt that will quietly drain a company's financial reserves over a decade. This flowchart illustrates the probate deadlock. HMRC requires the liquid portion of the tax to be paid before issuing the grant of probate. However, the executor needs the grant of probate to access the deceased's bank accounts to pay that exact tax. To break this cycle, HMRC provides a specific procedural tool known as a grant on credit. This arrangement allows the grant to be issued even if all or part of the tax has not been paid. A 2024 administrative reform significantly eased this process. Executors are no longer required to prove they were rejected for expensive commercial bridging loans before applying. Executors must still legally exhaust other prerequisites before approval. This includes utilizing the direct payment scheme and liquidating accessible life insurance policies. Successfully leveraging the grant on credit allows executors to safely initiate the 10-year installment structure, avoiding the need to rely on predatory corporate debt. The April 2026 reforms transform the transfer of business wealth into a significant corporate liquidity event, requiring precise cash flow management. Corporate survival relies on 3 non-negotiable steps: assessing your exposure to the £2.5 million cap, identifying your installment-eligible assets, and separating your interest-free liabilities from your interest-bearing ones. This content does not constitute formal legal, financial, or tax advice, and UK legislation remains subject to change. Business owners, corporate directors, and contractors must proactively restructure their corporate tax frameworks ahead of the 2026 deadline. Waiting for probate is not an option. Contact Pro Tax Accountant today to secure tailored, professional advisory. Call 07985 689 912 or email info@protaxaccountant.co.uk. Strategic modeling with Pro Tax Accountant provides the necessary framework to protect a lifetime of business building from a single tax deadline.